China this morning, it is betting big on its economic recovery after lifting the zero COVID policies. Beijing widely expected to announce a GDP growth target of around 5% for the year. And it's funny how that happens. The Communist Party says we will grow 5%, and the Chinese economy then grows 5%. China's economy grew 3% last year, missing the target of 5.5%. Joining me right now is Mobius Capital Partners founding partner, Mark Mobius. Mark, it's great to see you. Thanks so much for being here. You're allocating capital all over the world, and I want to get your take of the impact of China reopening, because you would think that that is going to, spark some demand for a whole host of commodities. Is that what you're seeing?
Yeah, you're seeing a beginning of that. Commodity prices are moving as a result of that. But the bottom line is that China is moving in a completely different direction than what Deng Xiaoping instituted when they started the big reform program. Now you have a government which is taking golden shares in companies all over China. That means they're going to try to control all of these companies. And you know what's happened already to Tencent and Alibaba and these companies. So I don't think it's a very good picture when you see the government becoming more and more control-oriented in the economy.
And that's exactly what we've seen, Mark, right? I mean, you're talking about Xi Jinping, really a different leader than even past CCP leaders. He's much more inward, models himself after Mao Zedong. I mean, for God's sakes, we keep seeing disappearances of people, right? Renaissance China's founder disappeared, and then the company said that they are, cooperating with the government probe. Have you lessened your exposure to China as a result of these provocations that we talk about every day, Mark?
Well, I'm personally affected because I have an account with HSBC in Shanghai. I can't get my money out. The government is restricting the flow of money out of the country. So I would be very, very careful in investing in China. What we're doing is going into Hong Kong, which seems to be a little more open and able to get money in and out. But putting money into China, I think you have to be very, very careful.
So they won't allow outflows right now, so you can't get your... I mean, that's significant, Mark.
It is. It's very significant. I can't get an explanation of why they're doing this. It's just amazing. They're putting all kinds of barriers. They don't say, no, you can't get your money out, but they say, give us all the records from 20 years of how you made this money and so forth.
Wow.
It's crazy.
That is crazy. That's scary, actually. Meanwhile, the American Chamber of Commerce in China's business sentiment survey showed a majority of U.S. companies say that China is no longer seen as the, quote, top 3 investment priority. This happening for the first time in the agency's 25-year history. Half of those companies say that they didn't turn a profit in China last year, with more than a third reporting China revenue fell year over year. Mark, I don't know why American companies have any belief that they're going to get, positive exposure operating in China as if they're going to get some kind of priority. They're not.
No, the problem is they're investing according to the index. The index now, 30% is China. So they say, OK, we got to invest in China in order to be in line with the index. I mean, this is like blind investing. It's incredible.
Yeah, I mean, it's all about money. So, what do you say to the Apple and, Apples of the world, Mark Tepper, and, the Bridgewaters of the world? Ray Dalio, a couple of weeks ago, literally a couple of weeks ago, he said he wanted to double down on Chinese stocks.
Yeah, I don't know how you can double down on Chinese stocks when Jack Ma disappears in the middle of the night.
That's right.
I don't know.
And look what Mark is telling us. He can't even get his money out.
I don't know how that is like an investable asset class. I have heard of like these hedge funds, trying to make a trade of it because of the whole China reopening thing. But we're also talking about a point in time where I mentioned Elon Musk earlier in the show. Who's now investing $5 billion into building a Mexican factory, probably to hedge his bets on that gigafactory he's got in Shanghai.
Oh, they don't like that.
Yeah.
So, Mark, is there an alternative for you? Have you upped your exposure elsewhere as you lessen the exposure to China?
India, number one, because you've got 1 billion people. They can do the same thing that the Chinese do. They can do the same kind of manufacturing and so forth. And I'm now in Brazil. Brazil, you've got 250 plus million people, very good people, open society. Hey, why not come here? This is another alternative.
Yeah, it's a good point. Mark, what about the United States? Tell us how you feel about the macro story right now. Do you want to lessen exposure to the U.S.? We're all told that these interest rate hikes, this string of interest rate hikes, it hasn't even been 12 months yet, right? They started in March, but it's supposed to take a year to actually have the impact. So there's a lag there. Do you think things get worse as a result of this, economically speaking?
No, I don't think so. I think the U.S. is in pretty good shape. And the reason why is that, let's face it, the U.S. is at war. They're at war in Ukraine and more at war with China indirectly. And when you have a war situation, spending goes up. Think about all these defense stocks that are getting massive orders. So that will generate a lot of growth in the economy. And that's the reason why you see the labor market being relatively tight in America. So I'm relatively bullish, despite the interest rates. If you look at the history of interest rates, high interest rates don't necessarily mean a poor market. So I think the U.S. looks pretty good.
Okay. Mark, we'll leave it there. It's great to see you this morning. Thanks so much.